How small apartment investors can analyze leverage effects. Calculate cash flow metrics with and without leverage. Net operating income or NOI. Calculate property income before financing costs to assess baseline profitability. Cash-on-cash return. Measure return on equity with leverage compared to an all-cash purchase. Debt service coverage ratio, or DSCR, is crucial. Ensure the property generates sufficient income to cover debt service obligations. Now let's compare financing scenarios. Scenario 1, an all-cash purchase. A 100% equity investment eliminates debt service costs but results in lower cash-on-cash returns. Scenario 2, leveraged purchase. Financing 75 to 80% of the purchase price reduces upfront equity but increases debt service costs. This approach requires careful cash flow analysis. Perform sensitivity analysis. Interest rate changes. Evaluate how fluctuations in interest rates affect cash flow and DSCR. Occupancy rates. Determine the break-even occupancy rate required to cover operating expenses and debt service. Market volatility. Assess the impact of declining property values or rental income on leveraged investments. Example: analyzing leverage effects on a multifamily property. Scenario: property purchase price $1 million, gross rental income $120,000 per year, operating expenses $40,000 per year, NOI $120,000 minus $40,000 equals $80,000 per year. Option 1, an all-cash purchase. The equity invested is $1 million. The cash flow or net operating income is $80,000 per year. This results in a cash-on-cash return of $80,000 divided by 1 million, which equals 8%. Option 2, leveraged purchase with 80% loan-to-value. The loan amount is $800,000, which is 80% LTV. The down payment or equity is $200,000. The interest rate is 5% with a 30-year fixed term. The monthly debt service is $4,295, which totals $51,540 annually. After debt service, the cash flow is $80,000 minus $51,540, resulting in $28,460. The cash-on-cash return is $28,460 divided by $200,000, equaling 14.2%. Insights: cash-on-cash return. Leverage increases the return on equity from 8% with an all-cash purchase to 14.2% when leveraged. Equity growth. The leveraged option builds equity over time through principal reduction. Now, let's talk about risk considerations. Leverage introduces debt service obligations, which can reduce cash flow margins. The investor must maintain sufficient cash reserves to manage potential vacancies or market downturns. Summary: leveraging debt in apartment investing is a powerful strategy to increase cash-on-cash returns, preserve liquidity, and grow portfolios. By analyzing the impact of leverage on cash flow and returns, small apartment investors can make informed decisions about financing strategies. While leverage amplifies returns in favorable conditions, careful risk management and sensitivity analysis are essential to ensure financial stability and long-term success.